In my time as a financial advisor before I retired, I used to get asked a lot of questions on superannuation. In this video, I'll cover the 7 questions that came up time and time again, and share the answers that I know can make a real difference to your financial future. Welcome to the Retire Well project. My name is Rob Bourne, and before retiring, I spent over 40 years helping people to navigate the complexities of taxation, superannuation, investment strategies, and retirement planning. Whether you're new to the workforce, eyeing retirement, or somewhere in between, understanding your super is one of the key factors that can help you maximize your benefits for retirement. We'll look at the details, dispel popular myths, and share practical tips to help you get the most from your superannuation. Let's jump straight into our very first question. Question 1. What is superannuation and how does it work? You would think this question is just from newbies coming into the workforce, but it's surprising how many people do not understand what superannuation is. Superannuation, often just called super, is Australia's unique way of helping us save for retirement. If you're working in Australia, you probably already have a super fund set up by your employer, even if you haven't thought much about it yet. Every time you get paid, your employer is required by law to pay a percentage of your ordinary time earnings into a super fund. Currently, the minimum rate they must contribute up to 30th of June 2025 is 11.5%. From the 1st of July 2025, this will increase to 12% of what you earn. Over the months and years, this adds up to a significant nest egg. The average account balance for males aged between 60 and 64 was $402,000 as at June 2021. There are many different super funds to choose from, but if you do not choose a super fund when you join an employer, they will nominate one for you which is called My Super. The super fund, either you or your employer chooses, invests your employer contributions into a range of assets, like Australian or international shares, property, bonds, or even cash. The aim is to grow your savings over time, so you have money waiting for you once you retire. Super can also include extra contributions from you, known as personal or voluntary contributions. You might add a bit more out of your own pocket, or set up salary sacrificing where some of your pay is contributed to super before tax. Plus, in some circumstances, the government can top it up with co-contributions if you're a lower income earner. The key point is that super is designed to be a long-term investment. You generally can't access it until you reach your preservation age, which is currently 60. So while it might feel far off, starting early and paying attention to your super can dramatically increase your lifestyle options when you retire. Question 2. How can I maximize my super balance before retirement? This is a question I get asked a lot. Most people don't start thinking seriously about their super until they're in their 40s or 50s. But the earlier you pay attention, the better. The magic ingredient here is compound interest. The earlier you start adding a little extra to your super, the more it grows over time. First, consider making extra voluntary contributions. This doesn't have to be a huge amount. Even $20 or $50 a week can make a significant difference over a decade or two. You can do this after tax or use salary sacrificing to contribute from your pre-tax pay. Salary sacrificing lowers your taxable income, so you might save on tax at the same time. Second, take time to review your investment options. Most super funds let you choose how your money is invested, so consider growth-type investments when you are young and then add some more conservative investment options as you get closer to retirement. Third, keep an eye on fees. High fees eat into your returns, and over a lifetime, this can mean tens of thousands of dollars less at retirement. Compare funds regularly and don't be afraid to switch if you find a better option that charges lower fees for similar or better performance. If you are in a My Super fund, you can compare fees across all funds by going to the ATO website. Fourth, consolidate your super accounts if you have more than one. Many people, especially after changing jobs, end up with multiple super funds, meaning multiple sets of fees being paid out of your savings. Rolling your super into a single account reduces duplicate fees and makes it easier to keep track of your money. Just make sure you don't lose any insurance benefits you might want to keep by moving funds. Lastly, consider spouse contributions if you or your partner are on a low income. Contributing to your spouse's super can help grow your retirement savings as a couple and might even entitle you to a tax offset. Question 3. How is my super taxed? Superannuation is taxed differently to the money you keep in a regular bank account or invest outside of super. This is because the government wants to encourage us to save for retirement, but there are rules to prevent super being used to avoid tax before retirement. Let's break down the 3 main times your super can be taxed. First, when contributions go in. If your employer contributes to your super, those are considered concessional before tax contributions and are taxed at 15% in the fund. If your income and concessional contributions are greater than $250,000 a year, you will pay an extra 15% on the excess. Personal after-tax contributions aren't taxed on the way in because you've already paid tax on that money. Second, your super fund pays tax on the investment earnings it makes for you: interest, dividends, capital gains, and so forth. Generally, these earnings are taxed at 15%, which is often less than your personal income tax rate. If your super fund invests in assets that go up in value over time, it will pay another tax called capital gains tax, usually at a reduced rate if the investment is held for more than a year. Third, when you take the money out after reaching preservation age at 60, withdrawals are tax-free. If you withdraw before your preservation age or don't meet the retirement conditions, you might pay higher tax rates. On top of this, there are limits, called caps, on how much you can contribute at the concessional 15% rate each year. If you go over those caps, extra tax applies. Q4. Question 4. When can I access my super? Accessing your super is tightly controlled so that it's there to support you in retirement, not before. The main factor is your preservation age, which is the age you can access your super if you're retired. This is currently 60. Once you reach your preservation age and have retired, you can choose how you use your super. Take it as a lump sum, transition it to a retirement income stream like an account-based pension or even a mix of both. There are very limited circumstances where early access is allowed, such as severe financial hardship or certain compassionate grounds, like urgent medical expenses or to prevent losing your home. Each of these situations has strict criteria, and you usually need to apply with evidence. One notable situation was during the COVID-19 pandemic, when the government temporarily allowed early access for people facing financial hardship. But in normal times, these exceptions are rare, and withdrawing super early can significantly reduce how much you have at retirement. Question 5. How do I choose or change my super fund? Picking a super fund isn't something you want to set and forget forever. Here's how to make a smart choice, and how to switch if you find something better. First and foremost, look at the fees. Every super fund charges fees. Some are quite low, others can be surprisingly high, especially when you add in admin, investment, and insurance premiums. Even a 1% difference in annual fees can make tens of thousands of dollars difference after a few decades of growth. Next up, check the fund's performance. Look at the returns over at least the past 5 or 10 years, not just last year. Super is meant for the long term, so you want a fund that can ride out the ups and downs of investment markets and still deliver strong returns. Examine the investment options each fund offers. Do they match your own attitude to risk and your stage of life? Many young Australians might want higher growth options, which include more shares and property, whereas those closer to retirement might prefer more conservative or balanced portfolios. Don't forget the extra features. Some funds offer good value insurance for life, TPD, total or permanent disability, or income protection cover. Think about whether you need those, as well as the quality of their customer service, mobile app, and tools to help you manage your super online. If you decide to change, it's usually quite easy. Just set up your new fund, complete a consolidation or rollover form, and they'll handle the transfer. Make sure your employer knows your new fund's details so your contributions keep flowing in. Double-check you're not losing valuable insurance policies when switching. Sometimes it's best to get professional advice first. Again, the ATO website is a good start to compare my super funds, and I will leave a link to their site in the description below. Question 6. What happens to my super if I die? It's not something anyone likes to think about, but it's crucial you get this right if you have a family you want your super to go to. Your super doesn't automatically fall under your will, unless you specifically set it up that way. Instead, your super fund may pay your balance, and any insurance benefits to your nominated beneficiary. To make sure your super goes to those you want it to, you need to make a binding nomination with your super fund. This tells them exactly who gets your super when you pass away. Eligible beneficiaries typically include your spouse or partner, your children, anyone financially dependent on you, or your estate. If you haven't nominated a valid beneficiary, the fund will usually pay the money based on its own rules. Sometimes this can take time and create confusion. Remember, each nomination usually needs to be updated every few years to stay valid. On the tax side, if your super goes to a dependent, like a spouse or young children, it's usually tax-free. If it goes to someone not considered a dependent for tax purposes, like an adult child, there could be taxes due. If you want more information on what tax is payable within super on death, have a look at my detailed video on this, which I will leave a link for in the description below. Question 7. Can I use my superannuation to buy my first home? Many people aren't aware that there is a specific scheme in Australia called the First Home Super Saver Scheme, FHSSS, that allows eligible first home buyers to use their super to help save for a home deposit. Under this scheme, you can make voluntary contributions to your super fund on top of what your employer already pays, and later withdraw those contributions plus associated earnings to buy your first home. Using the FHSS scheme, you can contribute up to a maximum of $15,000 in any one financial year, and up to a maximum of $50,000 across all years. Considering the annual and overall limits, you can withdraw 100% of your eligible personal voluntary contributions you haven't claimed a tax deduction for, 85% of your eligible salary sacrifice contributions, and 85% of eligible personal voluntary super contributions you have claimed a tax deduction for. This can be a smart way to save, as super contributions are typically taxed at a lower rate than your regular income, allowing your savings to grow more quickly. If you're considering using the FHSS scheme, speak to your super fund or a financial advisor to ensure you understand the process, eligibility, and potential tax implications. Thank you for watching and sticking around to the end. If you found this video helpful, please hit the like button and consider subscribing for more content on superannuation. If you have any questions or comments, leave them in the description below. Your questions might feature in my next Q&A video. Thanks for watching.